A more encouraging day for equity markets outside of the US yesterday, but some important developments occurring within the States. Stay tuned and we'll discuss the detail. There was a sense of early encouragement in markets yesterday after we heard from the Bank of Japan's deputy governor, who recognised that they will not look to raise interest rates further whilst we're seeing current market instability, recognising that the more hawkish tone which was presented when they rose interest rates from 0.1 to 0.25% last week did contribute to the market volatility which we saw. In Japan, Europe, the UK and emerging markets, they all held on to those positive gains throughout the course of the day. Within Europe, certain developments included an improvement in German industrial orders, but also some improvement in terms of the profit outlook from a number of the banks such as ABN AMRO. So important developments there which led to a more encouraging development in the equity markets. Within the US, the early gains were relatively short-lived. In the day, we had an auction from the Treasury, which is their way of raising capital by issuing bonds to the market. Over the last 12 to 18 months, bonds have been very well received from the market. So when you've had an auction, there's been a lot of demand. If we take a 10-year US Treasury bond as an example, the track record has been around 2.5 bids for every one available bond. Now, the auction which came through yesterday was met with demand of around 2.3 times, so slightly weaker. The reason being is we've seen a big rally in bonds last week as the market moved towards that asset class, given the softening in economic data which we've been seeing in the US, and therefore the increased probability that we'll see interest rates lower. So an environment which would be more supportive of that asset class. And for this reason, yields have moderated from around 4.2% to around 3.9%. So the highest bid which we saw through the course of the day was around 3.9%. So still under that 4% level. So relatively, there was a lower level of appetite to take on debt at that level. However, we did see the VIX index, which is also known as the Wall Street Fear Index, has abated quite materially. If we look at the VIX index now, it's around 23.7, and that's down from levels of 60, which we saw on Monday when we saw a really big increase in volatility. So we have seen quite a lot of moving parts over the last week or so, but implied volatility has came down quite materially over the last number of days. Today we're going to receive an update on the US initial jobless claims, and this data may attract more attention than usual, just given the raft of data which we had last week, which was, as I say, pointing to a slowing or a cooling of the labour market. But remember, we're talking about a labour market which is cooling from a very healthy level. We've seen a really strong labour market which has been very supportive of growth. And this was always part of the Federal Reserve's mandate in order to moderate the level of inflation in which we're seeing. They needed to cool demand in the economy. It's also going to be important, therefore, in terms of what it means for monetary policy as we look forward. We're going to hear today from President of the Richmond Fed, and the President is going to be giving some discussion, some perspectives in terms of their view on where the direction of monetary policy is going. But if we look this morning at the market's currently expecting that we'll see interest rates move to a range of around 4.75 to 5% from their current 5.25 to 5.50. And the expectation of that is around a 71% probability. So essentially what the market is saying is this may not just be a 25 basis point cut in September, it may be a 50 basis point cut. These developments are going to be important, so please do stay tuned here on Morning Markets for more information. Thank you for watching.